Good morning. I'm Kevin Jacques, a partner at Cota Capital, and I'm here with Martin Zych, the co-founder and CEO of Jirav, to talk with you for the next 30 minutes about the current fundraising market and what it takes to raise capital today. As I mentioned, I'm a partner at Cota Capital, and I've been an investor for almost 23 years. And let me introduce Martin. Martin is the CEO and co-founder of Jirav, which successfully raised a $20 million Series B in May this year. Jirav also is a tool that has helped dozens of clients raise money this year. And Martin, I think you're a CEO that spent quite a bit of time in your own customer's shoes. You were a director of finance at Limeade and Zephyr Health. How many years combined?
Oh gosh, at least 7 or 8 years between them.
And before that, then a controller and an accelerator. How many years there?
About 5 years.
So collectively, between Jirav and your clients and prior companies, you've helped raise over $200 million.
Yep. I think our Series B was the 17th venture round I've done in my career.
We'll dig into that in a minute. I always think it's important to help the audience understand, who they're listening to and what you do. So why don't you tell us a little bit about Jirav?
Yeah, so Giraffe is a all-in-one financial planning and analysis platform. We help small mid-market companies as well as accounting firms automate their FP&A processes. So think about that big 15-tab Excel file that you might use to build your financial model at a company. You're Frankensteining together accounting data, billing information, payroll data, and trying to show, where have we been and where are we going. We eliminate that process by the spreadsheet process of that and do it delightfully in the cloud in an automated way at scale.
A structured framework to help when you're in diligence with the VCs as opposed to trying to maintain all those Excel workbook tabs. All right, well, before we dive into the market conditions and what's going on with funding levels and valuations, we wanted to first run a quick 3-question poll for the audience to help us understand what parts of the market would be of highest interest. All right. So the first question, how many in the audience have either recently raised or you do plan to raise over the next 12 plus months? And this will be important. When we dive into that section, we'll see that what's going on is really valuations, for example, or the impact of recent changes really varies by stage. All right, just a couple more seconds here. Wes, can we move to the second question? For those of you that will be raising, what do you plan to raise? Venture capital, venture debt, private equity, angel, friends or family funding, maybe bank debt? I think the dynamics, what does it take, are slightly different in each. And finally, question 3. And we'll tie this back into the fundraising climate later. In managing your company, typically there's a lot of key metrics you might be tracking. How frequently are you tracking them today? Okay. Wes, do we have answers on those poll questions? Okay, we'll go backwards. So most of the audience are tracking these things quarterly or monthly or quarterly, or even less frequently than quarterly. Interesting. Almost 80%. Let's look at question 2. Half the audience will be raising venture capital, another part venture debt, another part private equity, and some angel funding. All right, and question 1, let's look at the timing. Almost half the audience raising now, almost 80% now or within the next year. Okay. With that, very helpful. So I think we've got some timely information for folks today. What is going on in the fundraising market? We've got some data here from Cota, and this is looking at total deals in dollars. So the total dollars invested by the venture capital industry over the last several years by quarter. Those are the colored bars. And then the white line are the total capital invested, deals in dollars. And so unfortunately, what we see is that dollars invested are down about 50% from peak levels of investment in 2021. And deal count is down a little bit more than that, around 75%, but essentially stabilizing potentially in Q1 and Q2 of this year. I'm sure that's not news to anybody on our webinar. As interest rates have been rising and IPOs are fewer and far between, that kind of ocean current of liquidity that flows into the limited partners who in turn reinvest that into venture funds really just isn't happening right now. So venture investors are raising the bar. They're investing less. They're asking more questions. And I think they're searching for efficient growth versus growth at all costs in the 2021 time period. Let's take a look at what's going on with valuations by round. And so as we can see on the chart, the impact and the change in valuations from 2021 peaks really vary by round. And so there's pretty good news. If you're raising a seed or Series A, those valuations are actually, relatively, they've gone up slightly since that 2021 time period. Where if you look at the later stage valuations, things are down, and in some cases for very late stage rounds, down dramatically. And again, private company valuations work backward from public company valuations. Higher rates have typically meant drops in public company valuations. And some analysts explain this phenomenon like a train deaccelerating. The boxcars are one by one, kind of, by round, crashing into the round ahead of them. Potentially signs of stabilization at later stage, Series C and Series B in the last 2 quarters. But again, I think we'll have to see, what will happen in the second half of the year. We'll have to see what goes on with interest rates, whether they keep rising or not, and what goes on probably with inflation. And our final fundraising climate slide. This is one of my favorites. I think a pretty interesting slide from Cota. The circles on the graph here represent what percentage of dollars invested are being invested at particular stages. And clearly, over the past 3 years, we see investors shifting towards earlier stages. This is very consistent with historical venture cycles. A lot of investors, as the market gets choppy, financing risk increases in the market, they tend to gravitate towards smaller checks at earlier rounds as a way of mitigating financing risk. All right, so what's changed? What does it take to raise a round today? We wanted to provide an entrepreneur's perspective, and Martin has just raised his round, and also the investor perspective. So Martin, you had a very successful Series B. You raised $20 million in May. Congratulations on a big round at a challenging time. Can you tell us how you did it?
Yeah.
What was different this time versus when you raised the Series A couple of years ago?
Yeah. Thanks. When we did our Series B, this is a challenging market out there, and I'm, honored and excited to have your backing on here. I think the big thing that's changed from when we did our Series A, is in the prior markets, you could see so many companies that, as long as you were showing growth, VCs would underwrite it and say, all right, you're going to be able to grow into this valuation. There'll be, less diligence, and people were moving very, very quickly. Now the market's shifted a lot. I think the premium now comes on to people who can actually show, is this the last round I need? Am I going to be able to with this, and then also, will I be able to steer the course? If for example, the economy stays bearish, will we be able to, work our way through this? The other ones are a really critical focus on like CAC efficiency and unique distribution models on that side. And having a repeatable process. That's really, really key. Being able to see those things.
Some of the difference one might expect at a Series A or Seed Plus, you're typically proving out product market fit. Show me how what's the validation for that. At Series B, a lot of it is about unit economics, go to market economics. But between the two rounds, how would you characterize kind of the difference in depth of diligence and your engagement with investors? A lot more questions, a lot more quantitative questions this time around?
Yeah, it's very heavy on all of your customer metrics on that side. And in the Series A, a lot of times investors are good with, you've got, several, you're growing, you've got enough to show that you have some product market fit. But then a Series A investor may see, okay, you just cracked 7 digits in ARR and you're growing at a certain clip, and talk to, a handful of customers as your reference and say, all right, well, let's grow this thing from there. In the Series B process, there's no stone left unturned. Those lists of those customers are bigger. There's way more interviews on that side, lots more back channeling, talking as well, a lot of times with, more people within the company too. It's many times it's not just a CEO pitching the VC and then you go get the term sheet, but you're, really betting on the leadership team in the company. And is this the squad that will make this thing a massive success? That's another big part on the Series B process. But the number one biggest one I think for Series B companies is that customer retention, net revenue retention, and expansion metrics as well. Those I think were like when I talk to VCs and they ask for certain KPIs and I ask them like, what's the most important thing for you? Those are the top 2 things that consistently are always popping up in people's diligence on that side.
So lots of feedback around, show me efficient growth, versus high growth.
Yeah.
So, very much. Very interesting. And Martin, you were able to leverage your own tool, to help drive some of this and minimize the wear and tear on your team and to be responsive in those questions. Very good. Very good.
Now, Kevin, what are the kind of things, as you're looking at the market right now, and you talked a little bit about there's that shift of going a little bit more investment in seed and kind of Series A. Is Cota focusing a little bit more on that side as well? And also the second part of that question is, what are the kind of things that Cota FinTech wants to see most today?
Well, Martin, thanks for asking. Look, I think, you hit on a number of the things that we're focused on. I think like many funds, there's a set of, I'll say sort of evergreen or in any market condition, things that you want to see, which is that strong team that you think will scale with the business. We ourselves are really interested in finding companies that have proven and validated product market fit and good signs of early traction. I think almost all investors want to see a really large addressable market. You want to see some differentiation and have a reason to believe that this is the team and the product and the company that's really going to take advantage of that market. But today, there's another three things that we're putting a really big emphasis on. First and foremost, I think, is having really manageable financing risk in the company. And I'll dive into what that means to us in just a minute. I think secondly, you want to see a team that really understands their business, that they've got really strong reporting, that there's a shared understanding of how well the company's doing, and you're able to use that information to, properly manage the business and be efficient. But I think something else we've seen is companies really more than ever over the last couple of years have needed to be agile. And I think some of that has to do with just the interesting and somewhat turbulent economic environment that we've seen post-COVID. And let me dive into those a little bit one by one. We saw in that Cota slide that a lot of investors have shifted to earlier stage, smaller checks, and they're viewing that as a way to manage financing risk. A year and a half ago, I thought that indeed might be what we would do. But actually, we've been able to find very manageable financing risk across the stages. I think it's a function of the company. In part, it's determined by what's the post money on the last round, what is the revenue growth and expense growth trajectory of the company. Are you growing? Are you growing efficiently? Are you kind of closing and lowering your burn rate every month as you grow efficiently? What's the strength of the investor syndicate that we're pulling together? How much reserves do the investors around the table have? We're trying to make sure that the companies we invest in today have, at a minimum, 18 months, even better, let's say 24 months of runway. We want to be able to ride through a period of high rates and tight valuations, but also give the companies and the management teams time to execute. We're thinking very hard about the reserves and the stage of life for the funds we're investing with. And heaven forbid, if we couldn't get another set of new investors at the table a year, 18 months from now, do we have reserves around the table to carry the company farther and hopefully get it to a great place? I think that is more important today than ever. It's hard to define. There's no one size fits all formula, but you can find, situations with very manageable risk at any stage. You can find situations with terrible go forward financing risk, even at that very early stage if certain things are set up wrong. Let me just hit on one more, the agility. A pattern that we've seen, the overall economy has been reasonably healthy as the United States and the world have kind of come out of COVID. But we've seen these kind of localized ripples and shifts, that hit individual sectors and segments, sometimes, without a lot of warning, and create a lot more disruption in that specific segment. What do I mean? There have been companies in the portfolio that ship physical products and they rely on suppliers. And when, those board suppliers and chip suppliers had supply chain bottlenecks, it created disruption. Those companies had demand and order for 2,000 parts. Well, they were on allocation and could get 800 parts for a couple of quarters, right? They had to react and adjust and reshape and resize their business really quickly. We've had other businesses, for example, that sold to regional banks. And when SVB, Signature Bank, and First Republic experienced trouble earlier this year, we had probably 2 quarters where regional banks really deferred purchasing new products if they could. They were very focused on building up reserves. Thankfully, that's coming back. But we expect there's going to be continued very localized disruptions, sometimes that are very hard to anticipate, where management teams are going to have to react quickly and be very agile in kind of managing their business. All right. Martin, what advice would you give to companies that are raising today? What specific advice?
Yeah, I think so. From that poll, like we showed, it was, I think, about a quarter of people were doing their angel rounds right now, and then about a half of people were doing venture rounds. So especially for the angel folks, I bet a lot of you, this might be like the first time you're trying to do a real big round, and it's kind of tough, or first or second time. I think the biggest ones as you're going through on these discussions, because people are a lot more risk averse now and they're looking at things more critically, is as you talk to folks, the first one's, there's no one size fits all for a pitch or for an investor. There's some basics that everyone's going to look for, but really kind of understanding, what is that investor's thesis? And it's, when you go into those discussions, being extremely prepared on, how big is their fund size? How many deals are they doing? Like a lot of times people may take your meeting and you may get excited, but then if you look on Crunchbase, you'd be like, hey, you've only done 2 deals in the last 2 years. Like, should that be someone you should go spend your time in? Or are they actively investing? Are they still partnering with companies? That's a really key one that I've seen to help, free up my time, because time's the most valuable thing you have and you need to be able to be efficient there. The other ones that I really like going into kind of an introductory pitch with an investor is just being very clear and asking them, what are your 2 or 3 most important core KPIs and metrics that you're looking for? And this can help you start kind of seeing, all right, do I need to, is this someone who's going for the moonshot super growth company? Is this someone who wants that break even company? And then from that, you can start tailoring, all right, here's what I'm good at. Here's maybe something that might not be a good fit for this type of profile. Those couple of bullet points would be, the main big ones going into a process like that. Aside from that,
and Martin, those resonate with me too. I think doing your homework on investors is super important. Are you in the right sector? Are you at the right stage for where they historically have written checks? Do you kind of fit their box? And then you're absolutely right. Are they raising, are they actually investing money today, or are they, distracted maybe with other issues in their portfolio? Venture firms don't tend to advertise that. You need to look and see if they're active today or not. And I think leverage a network. I agree. I'd also say from the investor side, it's really important to really know your business in depth. And even for, seed stage companies, super early stage companies, when a CEO, cannot crisply answer the question of what do you spend to get a customer today, or let me have the finance person answer, we'll get that tomorrow. That's a turnoff for me, right? How do you manage the business if you don't in your head know what those metrics are? I'm sure you need to make really quick choices throughout the day, and you don't always have time to wait for somebody to crunch numbers. Or I was actually quite shocked to see that a lot of the audience they're only tracking those numbers monthly or quarterly. I am a big advocate of, put some automation in place, a tool like Jirav. There's others. We won't only shamelessly promote Jirav, but I think having those reports, it's valuable information. It just helps you be agile. It helps you react. It helps you be efficient.
Yeah, I found if you build that muscle up, at first, get to the quarterly cadence just to figure out what you're doing. But really quickly, when you start refreshing this on a monthly basis, it will become more like a heartbeat in your business. And it won't feel like this heavy lift once you do it a couple of times. And then when you're talking about agility, now when you think about zigging and zagging and you got to course correct in your business, your zigs and zags aren't going to be so wide if you're doing this, on a monthly basis instead of that quarterly one where you're like, all right, the ship is going this way. Now I got to turn this way.
Well, and the reports are something that, not only do but you can share that across your entire management team. As you scale the company, you need to push decision-making down and leverage your team more. Great reporting is a way that you can do that.
Absolutely.
Martin, what are your customers telling you? You've got thousands of clients. A number of them have raised rounds recently. What are you learning from them?
I think, people who really are making that, their financial model a strategic tool in their business are the ones who are demonstrating that agility. And a lot of those folks, when COVID started a couple of years ago, every company in the world was forced to redo their budget and their forecast. And the ones who had that process and that muscle starting to build up survived and figured this out. And then we had, about a year of some, kind of a frothiness, and then now things are, turned around the other way. it's, I think those people who had built up that muscle, they're reacting quickly and they're able to course correct on their company. And we've seen, we see folks, the funding environments are tighter. As you see, it's like 2018 levels now. But the people who know their numbers are able to kind of demonstrate that path forward, who can get their burn in control. They're still able to raise. They're still able to be successful. It's not so dire that
where they've got a good underlying business. I agree. And folks, I think these capabilities are helpful even beyond raising money, just in working with your board. This is the automating and having the right solution in place is a great way to not keep your finance team, spending 2 weeks preparing for board meetings, but actually being able to help run the business in between the board meetings, because you've been able to automate, and then to show your board accurate financials, and really use the time with the board to focus on more strategic issues than are the numbers right. So
yeah, I think when you're looking at the numbers, 20% should be on the retroactive stuff, and then 80% should be where are we going, and that's empowering, that's invigorating when you're looking at those goals and then tracking that path towards where you want to be.
all right, we have about 3 minutes left in our scheduled time. I thought this might be a good time to turn things over. Does the audience have any questions? You can put a question in for Martin, myself, or both of us to answer using the chat, which is down at the bottom of the Zoom webinar screen. And while we're waiting for questions, and we have one now, from an anonymous attendee, what do you think is the right stage for a company to start to utilize a planning solution like Jirav?
I think we've got over 4,000 companies on our platform. It'll start from, even if if you have a dozen employees, that's probably $1 million payroll, which means you've either got investors or $1 million in revenue. And you're starting to think of like, how do I grow this thing? That's probably the floor. We go all the way up to hundreds of employees, and this just gets more and more important as you get bigger and bigger. And I think as you're building that muscle.
What about if I have one finance person or a fractional, maybe CFO, and it's at the point that I'm being pushed to add more resources. I think is that maybe the place. Automation can help my existing finance team do more or focus in areas that are more strategic. Is that a way to think about it?
Yeah, you'll be able to, save time on the monthly processes. So you'll be more efficient, as well as like if you're a fractional CFO or controller who might be helping small, some of these small businesses too. They'll be able to handle like within our customers, the average one can handle, a much higher ratio of clients per head in your firm. And then for the folks that are doing this in-house, it can free up a good, 10 to 20 hours a month of your time instead of rolling this forward in Excel. And that time can be spent on building your business, talking through the strategic stuff, and working on those kind of high value add activities for it.
Okay. Question number 2 is how long, and I'm going to assume this is the fundraising process they're talking about, how long does it take today versus before?
So historically, when I did rounds before, it could be like a 90-day process from, hey, let's go out to our pipeline till we get a term sheet. Now, we talk to entrepreneurs every day. People are, that's, I'd say, a minimum. And a lot of people are going, 6 months or even more trying to find that right fit. They're having to have more at-bats on that side.
I think 6 to 12 months is, parameters I coach the companies where I'm on the board to think about in terms of lead time to engage to successfully close a round. It definitely is taking longer today. Question number 3 from the investor side, do I think it's more important to do, I'm going to assume, more rigorous due diligence today than before, and is knowing the numbers important to ensure that the business has agility? I'd say the answer is yes and yes. You know, management teams, well, I early in my career was a BCG consultant, and BCG had a kind of a tagline: "What gets measured gets done." What's not measured really is tough to manage. And so, if companies aren't on top of the numbers, don't have great reporting, I don't know how they can be agile unless you've got leaders that just are intuitively sensing the right things to do in the business. And I think that's harder today than it's ever been. So for us, it's absolutely critical that there's good reporting, and that we see management teams on top of it that are able to react quickly. Final question: are revenues critical or mandatory for a PE raise? And it sounds like this might be in an R&D focused space, with military and commercial applications. And I'll give a quick first answer. I'll let Martin answer. I think certainly it's easier to raise when you do have revenues. Pre-revenue raises, I think it's important to focus on investors that know the market. And oftentimes it's investors then that have a deeper technology background, and they'll understand the importance. They'll have some sense of understanding and intimacy with the potential customers. And so they'll get comfortable that, yes, if you can build this or do this, it will be important to those customers. I think it's also, important to try and be efficient and raise less to prove that out rather than more.
Yeah, and I'd add on that too, like pre-revenue, it's tougher as you mentioned, but like even if you're say early stage as a startup and you've got an LOI from a big customer, you sign something with the government, or you sign this big massive one, that can help you, because then you can go out to the market and say, hey, I've got this massive teed up for XYZ dollars.
Great idea. Prospect referenceability, if that's what you have. I want to thank everyone for joining the webinar today. If you've got questions, please feel free to reach out to Martin or myself or Ryan on Martin's team. And now I will need to close with our required legal disclaimer. Thank you all.
Thanks, everybody.